Over the past episodes, we've talked about why traders lose because of position size, why high win rates can still fail, why price moves before news, why breakouts trap beginners. But all of these mistakes share the same root: the way we think. Today, let's talk about a hidden psychological trap that affects almost every investor today: confirmation bias. And in the age of social media and algorithms, this bias has become even stronger. Confirmation bias simply means we naturally prefer information that confirms what we already believe, and we tend to ignore information that challenges our opinions. But here's the problem: modern technology is designed in a way that amplifies this bias. Think about how recommendation algorithms work. When you search for something online or watch certain types of videos, the platform learns your preference. Then it shows you more of the same content. It's like going to a restaurant where the waiter says, "You liked this dish yesterday, so today we will only show you similar dishes." At first, that feels convenient, but over time, your menu becomes smaller and smaller. In investing, this can be dangerous. If you believe a certain stock will go up, the algorithm may start showing you bullish news, bullish opinions, bullish influencers. Soon it feels like everyone agrees with you. But in reality, you may simply be inside an algorithm bubble. Confirmation bias can turn social media into something like a mirror room. Imagine standing in a room surrounded by mirrors. Everywhere you look, you see your own reflection. It creates the illusion that many people agree with you. But in reality, you are just seeing the same reflection repeated again and again. On social media, this happens when you follow accounts that share your views, you read articles that confirm your opinion, you ignore information that challenges your thesis. The result is an echo chamber. Your confidence increases, but your understanding of the full picture decreases. Don't get me wrong, social media doesn't create bias, but it does amplify the bias you already have, and this is where many investors make mistakes. Here's the important part: the market does not work like social media. Social media shows you what you want to see, but the market reflects what everyone believes. Optimists, pessimists, hedge funds, long-term investors, short sellers, institutions, retail traders. All their opinions and capital combine together to form the market price. A famous investor once said, "In the short term, the market is a voting machine. In the long term, it is a weighing machine." What this means is simple. Prices move based on the combined decisions of millions of participants, not just the opinions inside your algorithm feed. This is why sometimes investors are shocked when the market moves against their expectations, because the market is seeing a bigger picture. So how can investors avoid falling into this trap? The key is to rely less on opinions and more on structured analysis. Instead of asking, "What do people say about this stock?" a better question is, what does the data actually show? Professional investors often focus on things like risk management, probability, position sizing, market structure, and quantitative signals. Because data is less affected by personal bias, numbers don't care about our opinions. They simply reflect reality. Confirmation bias is one of the most dangerous psychological traps in investing. Algorithms show us what we want to see. Social media can create echo chambers. And our own minds prefer information that confirms our beliefs. But the market is not a mirror. It is a complex system that reflects the combined expectations of millions of participants, which means successful investors must learn to step outside their own bias. They must look at the market objectively. If you want to understand the market through structured and data-driven analysis, subscribe to Profit Path. On this channel, we focus on quantitative thinking, probability, and disciplined investing, helping you avoid emotional traps and cognitive bias. because in the market, clear thinking is one of the most valuable advantages an investor can have. Thank you again for watching Profit Path.